This is Mark Warner with PropertyMortgageInvestment.com, here with the next series of how to compare a real estate investment in residential property against other investments that are available in the marketplace. Today I'd like to compare a property residential investment to a real estate investment trust, or what's commonly called a REIT. And a REIT can be either private or public. A public REIT is one that's traded on the New York Stock Exchange or other exchanges, versus one that's private and doesn't have the outside secondary market trading its stock. And as we've always talked, we look at appreciation, cash flow, tax savings, and debt reduction, which a property residential investment has those elements to it. In a real estate investment trust, you have various types of real estate investment trusts. You can buy commercial property, either apartments, office buildings, resort properties, hotel properties as an option, or you can buy debt type real estate investment trusts, which are mortgages against commercial property. So when you look at a real estate investment trust that's actually in property, you're looking for appreciation. Depending on how the property is bought, if they're looking for strictly appreciation, you may not have cash flow, but rented real estate will always have cash flow, or hopefully have cash flow above what their debt service is. There is some tax savings that are available. Again, you can depreciate real estate in a real estate investment trust, and you potentially have debt reduction depending on how much you've leased the property for. A real estate investment trust does have some liquidity features to it if it's already publicly traded. If it's not publicly traded, then it probably wouldn't have any liquidity features to it. So depending upon the type of real estate investment trust that you purchase, it would have all of the potential elements that we talk about in buying residential property investment. The thing that you get with a residential property investment or a REIT is you get somewhat like a mutual fund, only in the real estate arena, in the real estate market. So REITs have some of the same benefits that you would have in the property residential investment. The thing that you wouldn't have is if it's a mortgage REIT. A mortgage REIT's not going to have appreciation, it's not going to have tax savings, and it's not going to have debt reduction. So all you look for in a mortgage REIT is the cash flow. This is Mark Warner with PropertyMortgageInvestment.com.